Hello, everyone, and welcome to today's edition of the Seven Investing Podcast, where it's our mission to empower you to invest in your future. If you'd like to learn more about our long-term investing approach and see all of our stock market recommendations, please visit seveninvesting.com. My name is Simon Erickson. I'm the host of the show. I'm very excited. We have a fantastic show for you here today because we have not just one, but two incredible guests who are truly the experts in their fields. I'll start with John Maxfield. It's a name that might be familiar for several of you because he was actually the previous guest of our Seven Investing podcast. John, I like to describe as a lifelong student of banking. He's the writer of the Maxfield on Banks blog. He's also a host to a nationwide banking symposium that goes all across the United States. Truly one of the experts in this field. John, welcome back again to the Seven Investing podcast.
Simon, it is a pleasure, my man. It is always awesome. But particularly because Caitlin is here. So those of you who know, we have to disclose our biases. I am quite a fan of Caitlin, okay? So I am not going to fight with her today. We are going to have a conversation. And the reason I'm a fan of Caitlin is because we are both Wyoming natives, and there are only like 7 of us in the entire world. And so we got to stick together. And so Caitlin, whatever you want, like, I'm here, all right?
How small is this world? His aunt was my high school English teacher. There you go.
Yeah.
A small word, and now I believe I did some research. I believe it's Wyomingite is the correct description.
Yep.
Okay, yes, okay, great. So another Wyomingite on the show is Caitlin Long. Caitlin is the founder and CEO of Custodia Bank, offers a variety of banking and money market services. Also one of the earliest adopters and promoters of cryptocurrency. Caitlin was part of the Wyoming Blockchain Task Force early on. I heard a great story, Caitlin, that you tried to give Bitcoin and cryptocurrency back to your alma mater, wasn't able to facilitate the transaction. You said, we've got to figure this out and make a new environment that's more pro crypto in the world. She has also kind of been doing a lot of different things with Wyoming, helped to get the first digital asset company that's banking charter back in 20, and kind of really an expert, not only on the business side of it, also on the legal side of it. I speak on behalf of John as well, Caitlin. Really excited to have you on the Seven Investing podcast today.
Yeah, thank you. And I came from the banking world before. I spent 22 years for big New York GSIBs, was a managing director for the bulk of those at Credit Suisse and Morgan Stanley. So came from the traditional financial world. For the bankers who are listening to this, definitely big bank focus is my background, but found Bitcoin in 2012 and was very, very interested in the intersection of the two systems.
Okay, and Simon, Caitlin is being a little bit too modest. She worked with John Mack, and she was in the running to be the CFO of Credit Suisse Group. So like, she may just dismiss those things, but we should not dismiss them.
We shouldn't. Like I said up front, we've got some fantastic experts. It's going to be a little bit different than maybe perhaps other podcasts that you've heard about crypto. We've got 2 experts on the show here. John and Caitlin are truly experts in their fields. So we're not going to do the Bitcoin 101 show. We're going to go into some very specific topics. And I think it's going to be an interesting back and forth, very insightful, but also it's okay to have a little bit of a disagreement in a true organic conversation here. But keeping in mind, these are 2 people that very well know the industry, know the legal environment that we're in, are also very aware of the political environment that we're in right now, all of which have an influence on the banking system and then also on the crypto system. So let's start with Silvergate. This is the first topic that I'd like to introduce here, John. John, this is something that you actually brought to the table. Of course, this was the San Diego-based crypto bank, was kind of associated with FTX and Sam Bankman-Fried early on. There was a run on the bank, but it survived that run on the bank. Now tell me why this is such an interesting story, referring, of course, back to your tweet from a couple of days ago.
All right, so the Silvergate story is interesting from a variety of angles. Let me just briefly walk through the story of Silvergate, and then that will get us to, then we'll understand what we're talking about right now. Okay, so Silvergate was a small thrift based in basically San Diego, a suburb of San Diego. And it was in the 1980s, there was this thing called the Southwest Plan, where all these investment bankers went in and bought these banks that were failing in Texas. And so a gentleman that was involved in the Southwest Plan and buying all these banks came over to California, and with a group of investors, the same investors that invested in those banks, came over and bought this thrift in San Diego. And they were just going to run. They bought it for, I'm sure they paid absolutely nothing for it because it was probably in trouble. And so they were just running it as kind of a regular thrift and kind of just earning your money on interest rate arbitrage. And then at a certain point, the CEO, they hired a new CEO by the name of Alan Lane. And Alan Lane is one of those guys who like tinkers with all new stuff. And he's like constantly looking at new stuff and that kind, he's like one of those guys. And he started dinking around in Bitcoin early on. I think it was in 2012. And so they start doing it and they realized that like, Look, because they go clean into the financial crisis because they got out of mortgages in like 2005 or 6. It was like brilliant. So they're clean through the crisis and they can lend all this money now because they don't have bad loans on their book, but they need deposits. And so Alan Lane is like, well, let's bank the crypto industry because they have all this cash, but nobody's willing to bank them. So that will solve our problem of bringing in more cash, and it will solve their problem of not having access to the banking system in the United States. So they do this, and they start building it out. And they're not just they start just banking them, but then they build this network that's kind of based on the kind of blockchain idea where if they put all the big institutional traders on the same network, they can move money 24 hours a day, 7 days a week. Okay, so it is incredibly valuable. It is a piece of the infrastructure of cryptocurrency in the United States, or was, okay? So all along the way, and I know people at Silvergate, and I was following it the entire time because I had friends there the whole time, okay? All along the way, the regulators were like, okay, that looks fine, or they were not objecting. That looks fine. Silvergate brought them along all along the way. That looks fine, that looks fine, that looks fine, that looks fine. So they build up this big business. The liquidity floods into the system in 2020 and 2021. A bunch of that floods into like VC stuff, kind of that speculative stuff. So a lot goes into cryptocurrency. Silvergate boosts way up. Then FTX, you alluded to this, Simon. FTX goes down in November. It was November, right, Caitlin? In November
11th, 2022. Yep.
2022. November 11th, 2022. FTX goes down and it causes this disruption in the cryptocurrency market and deposits flood out of Silvergate. Now, here's what's interesting. Now, I don't go around saying that I'm an expert on anything, okay? But I happen to probably know more about bank failures in the United States than anybody else, okay? Just because I've spent so many hundreds and maybe thousands of hours studying them, okay? And one of the things you find is that the thing that causes banks to fail typically isn't a solvency issue, it's a liquidity issue. And so it's when you have a run on the bank, and typically, like, a typical bank can't survive a 10% or 20% run. Silvergate survived a 70% run on its deposits. I have never seen anything even close to that in all the studying I've done. And I've studied hundreds, maybe thousands of bank failures. It was incredible that they could survive that run. But then what happened after that was that the regulators came in January 23 and limited the percentage of deposits that they could allocate to cryptocurrency. The problem is that basically 100, I don't know, it was 95% or 96% or 100%. For all intents and purposes, 100% of their deposits were crypto-related deposits. So by the regulators coming in and saying that you have to limit it to, I can't remember if it was 15% or a de minimis amount, they basically got rid of their business model of Silvergate. So Silvergate basically had to shut down. So that's the story of Silvergate.
I'll pass it to you in a second here, Caitlin, just for some comments on this as well. But just to kind of recap what you said there, John, you said that it's a liquidity issue, which is just a difficulty in banks converting the assets that they have into cash when people demand their cash back out. And like you mentioned, Silvergate was interesting because they had 95% of its assets were in crypto, which was something that it was able to survive this liquidity problem that so many banks have. You described this as pioneering a new idea, but then being shot in the back by arrows. It was the regulators that got this bank, not necessarily the run on the bank itself that caused it to go through these issues. Is that the correct recap of what's going on with Silvergate?
The way I conceptualize it is that it was a bait and switch. The regulators brought them along. They build this business. They hire these employees. They build out this network. They're serving this community. The regulators are saying all along that, or they're not objecting. They're aware of what's going on all along, and then they turn around and say no. And so that's the problem. It's like in law. I went to law school. In law, like if you represent something and somebody relies on it, you have a legal obligation to deliver on that. That's how I conceptualize it. And so, and Caitlin she should weigh in on this, but that's how I think about it.
Yeah, this is sounding very, very similar to what Custodia experienced, because along that time, we sued the Fed, and what came out in the litigation, again, just to give you the timeline, November 11th, 2022, FTX fails. November 14th, 2022, the Fed was going to approve Custodia. There was a meeting to talk about the conditions for approving us. November 22nd, 2022, Michael Barr has a meeting. He's the vice chair of supervision to discuss Custodia. And then November 26th or 27th, whatever that Sunday after Thanksgiving was the first discussion of denying Custodia. The reason I bring up Custodia in the context of Silvergate is at one time I said we were the first ones attacked by Operation Choke Point 2.0, which was the dragnet by federal bank regulators against the banks that were serving the crypto industry. And Alan called me and said, no, Silvergate was first. Well, I can now say, because multiple insiders have come forward to tell me that it was at the same time. The Fed went after 5 banks on the Sunday after Thanksgiving. Stop and think about this. The Sunday after Thanksgiving. And if it weren't for the custodial lawsuit, we wouldn't have known to look at that period of time. Because to your point, the Silvergate wasn't told by the Fed, wasn't given the ultimatum. And by the way, why are we talking about Silvergate now when it's a couple years later? There was a filing. They actually filed to liquidate the holding company. This is a bank that liquidated. It didn't fail. Big difference. They gave all the customers money back, no haircuts, and they're giving shareholders money back. And so now they filed a filing to liquidate the holding company. And in that filing from their chief administrative officer, which was filed in October, there was the disclosure, and it was a bombshell because I thought that Silvergate didn't survive the bank run. The narrative, and it was so easy in the banking industry to portray it as this bank failed because that's what happens when banks have bank runs. But that's why John's point is so spot on, that the banking industry needs to look at this and learn from it. And needs to also recognize that this was a company that had survived a bank run, clearly had issues, clearly had compliance challenges with FTX, clearly had some solvency challenges, but it was solvent and liquid, and it was shot by the Fed.
I'd like to ask a follow-up question to both of you. Since you guys are the experts, I get to be the moderator. I don't have to answer this one. It's a tough one. But, knowing that Silvergate had 95% of its assets in crypto before, which the banking industry and the regulators deemed too high, and then they put what sounded like what you said, John, a too low of a mark, 15% or whatever 15%. It was of the maximum amount. What should be the correct amount that a bank can hold in crypto assets? If 95% is too high, but perhaps 15% is too low. John, I'll go to you first on this one.
So I don't think there's a right answer. I couldn't tell you the number. I don't think there's like a silver bullet number. Okay. But here's a couple things to keep in mind. So number one, I go around this country preaching the most conservative banking philosophy, okay? I'm not somebody who's out on a limb saying that banks should be out doing wild things, okay? That is not my style, okay? There is no more conservative bank than a bank that can survive 70% run, okay? In terms of managing liquidity, which is the job of a bank, okay? It is incredibly impressive what they did. The bigger question is in this context, it's not the percentage, it's whether it's right for the regulators to drag these people along, growing the business, and then change it. That's the issue. The issue isn't about the business model. The issue is about regulators, in my opinion, mistreating them.
Well, that's really interesting because Alan understood. In fact, actually, he reached out to me. So Custodia has a Wyoming Special Purpose Depository Institution charter, and by statute, we're not permitted to lend. Why? Because we're serving the crypto industry. And so, Simon, actually, there's one clarification. They weren't sitting with 95% of their assets in crypto. 95% of their demand deposits came from the crypto industry. They were sitting with pretty close to 100% of their assets in cash and T-bills. And that's how they were able to, cash and treasuries, I'll come back in a second and make a distinction. But that's how, to answer John's question, how did they survive a 70% run? Because they were that liquid. Now, they knew they needed to be that liquid. And the reason I bring up the Wyoming Special Purpose Depository Institution charter is because I think Alan's not going to be mad at me for disclosing that he called back when Wyoming was putting this together. He was looking seriously at it because he was thinking about separating the old thrift business from the new crypto banking business. And he knew that when you're banking super hot money deposits that could literally be withdrawn in the span of seconds, which is what this is. This is very, very tech forward deposits. And it's the ultimate hot money because it's, as we learned in Silicon Valley Bank, online banking, your deposits, you can have a bank run. It used to be that the tabletop exercises assumed a bank run would happen over 2 weeks. Well, Silicon Valley it failed in 2 days. By the way, the bank run of Silicon Valley started the day after Silvergate announced that it was quote unquote voluntarily liquidating. We now know that that was not voluntary. The Fed pressured it to do exactly that. And a lot of people in the crypto industry, when we looked at that, concluded it was the Fed that started that bank run. It was Michael Barr who instigated it, because into jittery markets, Silvergate announcing that it was liquidating a relatively small bank in La Jolla, California, was big enough to start a systemic run. Stop and think about that. But Silvergate itself was well managed in that regard, with not taking credit risk. They were not making loans because they knew that that their demand deposit pool was hot money. Where they got into some degree of trouble was they were taking some of the maturity transformation risk. It wasn't all T-bills. There were notes and bonds in that portfolio as well, and that was part of the reason why they did actually have their capital ratios went way down, etc. But I found out through insiders, not from Silvergate. I had multiple insiders come forward to tell me when I put a call out to try to figure out what was going on. These were not Silvergate people. Silvergate never borrowed from the discount window and did not have challenges. In fact, actually, part of what caused Silvergate to be cut off was that it was cut off by the Federal Home Loan Bank.
Let me draw a finer point to something Caitlin just said, because this is a really important point that casts light into how this bank was being managed, okay? The thing you have to be worried about with a bank, because they're so leveraged, is you've got to be worried about the assets you're putting on your balance sheet, okay? And so you can put loans on your balance sheet, or you can put securities on your balance sheet or cash, right? So you look at if you were to look at the Silvergate story, you think like, oh, well, this is a bank serving the crypto community. They're lending a bunch of money to these crypto companies. They started like inching into that, okay? Inching into that so carefully, knowing the situation, knowing how these money flows go. And I can't remember I think the collateral on it was like 10%. I mean, it was like 100% versus 10%. I mean, they were so over collateralized on those loans, and it was
they never had any loan losses on it.
No loans,
right?
Tiny little portion. So, like, not only do we know that they were careful about it, like because they didn't do it, we know they were careful about it because we watched them do it carefully. You know what I mean? My point is that, like, look, people, a lot of the bankers who would watch us be like, why is John Maxfield out there like supporting Silvergate? It's because the story is misunderstood. The story is misunderstood. These people deserve credit for surviving a bank run like that. And that's where I can come in and give them the credibility.
I'd like to use that as a segue to the next topic that I'd like to talk about. Caitlin, I'll start with you on this one because you've been very progressive with Wyoming and how pro-crypto it's been, right? Crypto country, I think it's referred to several times because of a lot of the efforts that you had, in recognizing the legal status of crypto assets there and not having taxes on crypto gains and kind of having the government a little bit more hands off, letting the market do its thing. We are under an administration change right now at the federal government level. And there are already some changes that might have some implications for the crypto side of the financial services industry, specifically in the SEC. We've just seen the appointment now. Gary Gensler will be stepping down, previous SEC chairman, who was very.
Don't shed it here, Caitlin. Don't shed it here.
No one cry over this, but just to point out,
Gruber's stepping down. I'm sure you're going to be totally.
Barr hasn't stepped down yet, but Grunberg and Gensler are gone. Yeah.
And to put some numbers, there were more than 100 actions taken against the crypto industry, regulatory actions. There was actually an executive order from the Biden administration for ensuring the responsible development of it. Was just very kind of restrictive on a lot of things that could be done. We've now seen Paul Atkins get appointed for the new SEC chair. It seems to be much more crypto friendly. What's your overall thought, first of all, Caitlin, on the new administration coming in?
Well, so it can't be any worse than what it was. We don't know exactly what it's going to be because Trump hasn't said what exactly he's going to do, other than that he vowed to end Operation Choke Point 2.0, which is the phrase that refers to all the debanking that has been going on. The debanking, we know, was industry wide, and the whole Operation Choke Point 2.0 was aimed at going after we would say in Wyoming, shooting the stallion to scatter the herd. Who did they go after hardest? They went after, the most law-abiding, the ones who were most trying to live within the regulatory guardrails. So in securities, it was Coinbase, and in banking, it was Custodia. And we got the farthest along, respectively, in the securities and banking world, getting to regulatory acceptance. What I think has happened and gotten lost in all this, and certainly got blanket handled by the Biden administration, is that they decided all crypto was bad, and we weren't going to let any of even the law-abiding players in, and they were trying very hard to push everybody out, and they succeeded in pushing a lot of companies out. Those of us who did stick it out and did survive it are now arguably in a position to do better, but we don't know what the upswing is going to be. No question there will be a reversal of a lot of the crazy things that happened. I'll bet a lot of the bankers listening to this don't know that the SEC overruled FASB on a US GAAP accounting standard relating to crypto, just to try to throw sand in the wheels of the crypto industry. It's called SAB 121, where I won't go into the details. Just know that the SEC overruled the FASB. I don't think that's ever happened before. That's how anti-crypto they were. Same thing in banking. While they were saying that banks could service the law-abiding crypto industry, what was actually happening, what they really meant, was a dragnet against the whole industry. And it's just coming out now. Coinbase filed a FOIA lawsuit against the FDIC, and they've now gotten 30 different letters that were sent to 30 different banks, and a disclosure from the FDIC that it went after 96 banks serving the crypto industry in the pre-FTX days. And we don't even have all the discovery in the post-FTX days, where, as I alluded to, I know that the Fed went after 5 banks, and it had not announced it yet in November 2022. There was no public disclosure. There was no, rulemaking or anything like that. And administrative lawyers tell me that is illegal. And I believe that will be investigated, or at least examined pretty heavily by the new regime.
And let me add to what Caitlin just said, because, and again, like Caitlin and I, so if you have like a Venn diagram, there's separate circles, but they overlap. There's quite a bit of overlap. And in that overlap is this agreement around the way the regulatory kind of structure has been acting, particularly since the financial crisis, particularly since Dodd-Frank. If you look,
Yes.
and you probably see that chart I posted of new bank formation in the United States, going back to, I think, into the 80s. It's cyclical, so it goes ups and down, but you're probably like 100 an average of new banks a year. After Dodd-Frank, they raised the capital requirements to $25 million from $10 million. Literally, it totally got rid of all new bank formation. Okay, here's the other thing. I go around and I talk to the best bankers in the country. These are the best, okay? And so, I'm not going to name names because they're not going to want their regulatory conversations to be out there in public, okay? But there was one of the top bankers in this country that in 2019, 2020, 2021, when interest rates were zero, he kept zero securities on his balance sheet. The regulators were trying to force him to put securities on his balance sheet. Not only securities, but not mortgage-backed securities, so non-convex. So when things go bad, they go bad at a double rate. Do you know what I mean? And they were saying, if you buy these mortgage-backed securities, particularly these subprime ones, you'll get a better score on your CRA score. And if you get a good score on your CRA score, then we'll let you continue buying banks. This is one of the top banking operators in America, and he is an amazing person, okay? And so he just said, I'm not putting those on my balance sheet, so I guess I just don't get to buy any more banks. So here the regulators have come in, told him to put mortgage-backed securities on his balance sheet that could have decimated his bank. And because he didn't do it, he doesn't get to buy any more banks. That's a situation that we're dealing with in the environment. I have another very good friend, one of the top banks in this country. I don't want to be too clear about this. He was accused of redlining, racial profiling customers. This guy is like the least racist person in the world. You know what I mean? And so it's like the regulators it's just gone totally out of control over the last decade and a half. And they've just got so much power, and that power has gone to their head. And by getting to their head, I believe that it's harming the United States economy.
So it sounds like the Venn diagram overlap in this is that the regulations of the past administration, and perhaps even before that, was a little bit too much, right? Whether it was Dodd-Frank and capital requirements, the operating costs that banks had to do to abide by regulations, or just kind of going after the crypto industry as a whole. It seems like there is a little bit more enthusiasm and optimism about the administration coming up from both of you on the sides of the Venn diagram that you.
Definitely. And when we were talking yesterday about doing this podcast, John and I both agreed bank supervision is going to be overhauled. We don't know what it's going to look like, but because of exactly what you're talking about, and I would point to a couple of different things: reputation risk. being something that supervisors have to use, you could see, and Julie Hill, another Wyomingite, by the way, she's the dean of the University of Wyoming Law School.
Very good friend of both of ours. We love.
Yes, exactly. And John's uncle used to be the dean of the University of Wyoming Law School. So Wyoming's a small, very, very exclusive club. But she wrote a law review article when she was at Alabama in 2019 about bank regulation and how that was going to be abused and become politicized, and that was going to hurt the reputations of the regulators. Boy, was that prescient, because that's what we're seeing right now. So that, I think, reputation risk, afuera, to use Millet's phrase, it's going to be gone. It's not going to be something, I think, that bank regulators or bank examiners are going to be required or allowed to use anymore. And then another example I gave of where some of the abuses, I think, took place is in adverse media, which is something that the compliance officers are required to assess for all customers. And I'll ask the question rhetorically, do we think that some of the hit pieces put out in the press on some of the people who were targeted for debanking might have been deliberately put there to increase the chance that they lost their bank relationships? Probably yes.
Probably. That is a rhetorical question, Caitlin.
I'd like to follow up on that a little bit, Caitlin. For those on the audience that might not be familiar with debanking and what this means, this is something that you mentioned earlier, the Operation Choke Point 2.0, something Mark Andreessen has spoken about before, about using banks, going against their political enemies and disfavored technical startups. Basically more than 30 founders of crypto companies have kind of been kicked out of their bank accounts over the past years. What is going on? And is this going to continue, or is this something that's being fixed now?
Well, it's real. And it's a lot more than 30. That was just in the Andreessen family. We saw other VCs come out in one case and say more than 90 companies in their portfolio had been debanked. It's the entirety of the crypto industry. It's a significant percentage of the fintech industry. It's also religious groups and regime critics, even the Trump family. So it is a continuation of the first Operation Choke Point, which started in 2013. That started with the payday lenders and was Marty Gruenberg at the FDIC, who was the instigator of that. There was a lawsuit, and it was settled in 2017, and the FDIC admitted wrongdoing, said they won't do it again, and they were going to train their examiners on not being abusive of their authority. Well, Yellen and McWilliams, obviously, when she came in during the Trump administration, tried to stop it. She testified to Congress multiple times about it, thought it was over, but then as soon as Gruenberg got back in, it came right back, right? We started to see in 2021 these pause letters, PAUSE, pause letters sent out by the FDIC en masse to any of the banks that were doing anything in crypto. And the FDIC inspector general even criticized, because those were not pause letters. Those were cease and desist letters, because the way that they said it was, we want to review your activities, but then they never gave any guidance on what was acceptable, and they never gave any timeline on how long the pause was supposed to be. So there were abuses here, and I think what's so interesting, the Me Too analogy is apt, because there were walls of confidentiality behind which a lot of probable wrongdoing was happening and was not disclosed publicly. But just like Me Too, where non-disparagement agreements and non-disclosure agreements between employer and employee kept these things behind closed doors. That happened here because of the CSI requirements, confidential supervisory information, and non-disclosure agreements between banks and customers, or between banks and banks, in our case, that a lot of it couldn't be talked about publicly. But it is coming out, there's now just been a floodgate and opened, and literally hundreds of people have posted their account closure letters on Twitter. And of course, we all know as bank experts why those letters don't explicitly say we're closing your account because you're in crypto, but we know that's actually what's happened. And there've been a lot of verbal conversations, wink, wink, nod, nod. And in Custodia's case, we knew the Fed was pressuring our partner banks in multiple instances. And then all of a sudden the account gets closed. It's not difficult to conclude who caused the account to be closed.
Now, let me be clear, Simon, and I'll speak for Caitlin too, and I know I can speak for her because we talked about this specific thing yesterday. Neither Caitlin or I are saying that we think the banking industry should be free reign for money launderers or for criminals or for anything like that. Like they need to be policed. We need to watch those things. We learned that lesson on September 11th. You know what I mean? We learned that lesson the hard way. You know, we are not saying that. But what we are saying is the seemingly arbitrary enforcement of regulations sometimes is a little bit unreasonable, because you can't, in that environment, when there's arbitrary decisions being made on the regulatory front, like it is very difficult to run an operation in a responsible way in that environment.
And
let me give you one specific example, like marijuana, right? Marijuana dispensaries, like they sit on a ton of cash, okay? And they're in fear of being robbed all the time and stuff like that. So like, yeah, it would be nice if all these states have legalized it, if they could put that cash in a safe place, right? The problem is that the federal law makes it illegal. So banks cannot do that. So in this case, like, you can't. The marijuana dispensaries are not an example of being debanked. That's an example of a federal law that if this country is going to be cool with everybody smoking weed, which like we're cool with that, we're cool with that. But that law needs to change, because we can't ask banks to go out there and put themselves on the line for criminal liability to just serve an industry.
Yeah, look, FTX should have been debanked. Right, because and a lot of the banks that were, including Silvergate, that we're talking about, were caught up in that. In fact, I just went back and looked, because the FDIC disclosed 11 banks had compliance problems with with FTX, where they were caught up, where the compliance departments or risk managers or both should have caught that wires were going to Alameda that were meant for FTX. Okay, this is basic stuff, and here are the names of the banks that I picked up, because you could pick it up, even though the FDIC said 11 banks, you could pick out at least 9 of those from the FTX bankruptcy filing. Okay, these are big names in some cases: Bank of America, Customers Bank, Evolve, JP Morgan, Moonstone Bank, Signature Bank, Silicon Valley Bank, Silvergate Bank, Wells Fargo. There are 2 others, BCB Bank and Equity Bank. I don't know if those were the US versions. I found there were non-US versions of them as well, but I just named you 11 banks, and the FDIC said there were 11 banks that were caught up in that problem. Okay, so absolutely those were issues. I will tell you, as somebody who was helping the FBI in the summer of 2022 bring down FTX, because those of us who were good actors in the crypto industry knew it was a criminal organization, I'm dumbfounded that many banks didn't figure this out, because those of us in the crypto industry who knew what we were doing, we knew. But think about some of those banks, and then stop and ask yourself, because a lot of the audience here is banks, where were the enforcement actions against Bank of America, JP Morgan, and Wells Fargo? Why is it that the smaller banks got nailed, but the big banks didn't? Good question.
Let me bring an even finer point to that. JP Morgan banked Madoff. I respect JP Morgan. I respect their controls. But you miss it. Companies make mistakes. I make mistakes. Caitlin, you make mistakes. Simon, we make mistakes every single day. But because they made a mistake with like an FTX, to come in and give them the death penalty, it's just after they've dragged them along for all these years, that is the issue. It is just an inequitable outcome.
Well, and disparate treatment between the community and regional banking organizations versus the large banking organizations. And I happen to know, again, from talking not to Silvergate insiders, these were other people who were directly connected to this situation, and including some people from Signature Bank. The vast majority of FTX's wires went through GSIBs, not through the small banks. Why? Because it was a global company. So, and by the way, if you look at the FTX bankruptcy list, there were several GSIBs that were not US based on that list, in addition to B of A, JP Morgan, and Wells Fargo. Why did none of them get nailed when the small banks did?
Yep.
Yeah.
Consistently.
It's just another iteration of too big to fail. It's just another iteration of that is what it is. And I don't mean to be mean towards the regulators. I am sure that these people go to their jobs every day and just try to do their best. I am certain of that. You know what I mean? I'm sure there's some of them that are bad actors, but 80% of them, I bet they're just normal people just like us going to work every day. You know what I mean? But what you find is that when you get into an environment, you adapt to the culture. And if the culture of these regulatory agencies is to just slam down on these banks and to not understand the role that they play in the economy and how important economic growth is to all Americans, whether we admit it or not, is a mistake.
Well, John's point about so few banks being started in Custodia as a de novo bank. Why are we not FDIC insured? Because we knew Marty Gruenberg was going to block us. And we tested that when a regulation changed about stablecoins and said you had to be an insured depository institution. We said, okay. So we applied to the FDIC. And of course, the answer was 18 ways from Sunday, hell no. Right. And but there's a bigger issue, which I'm excited about now that Gruenberg's gone or will be gone shortly, which is that there was a real anti-innovation thrust in the FDIC during his entire tenure, which not coincidentally spans the vast majority of the time since the financial crisis up to today. And that pushed a lot of the innovation into outside of the regulatory perimeter. One of the things Wyoming was trying to do was bring the innovation inside the bank regulatory perimeter, where, to John's point, all of the Bank Secrecy Act and OFAC and CFT and anti-money laundering requirements are higher than they are in non-banks. And so, but what's happening is the gap between not just the understanding of technology at the regulators, but between the actual technology in the fintech industry versus the banks is staggering in size now. And I'll close by saying, I don't begrudge the banks who are trying to move forward. I think what Silvergate built with that 24/7, 365 US dollar platform was incredible. And they led, multiple banks have tried to copy it. Customers Bank is operating one of those right now. And of course, got an enforcement action. Again, dragnet against the crypto industry. But step back and think about this as risk managers. Bitcoin trades 24/7, 365, huge trading volume in the ETFs right now. Fedwire only settles during Fedwire hours. And the SEC, to throw sands in the crypto industry's wheels, made the ETFs go through a cash create intermediate step. So every time an ETF unit gets created or redeemed, it has to go through US dollars, but that only settles during Fedwire hours. Now, doesn't that put into context the risk reducing aspect of Silvergate offering 24/7, 365 settlement of US dollars to the crypto industry? Because nobody had to carry unsettled trade exposures overnight and on weekends. And I have personally warned senior officials at the Fed on this. In between our litigation, I went straight to a senior person and said, I know you understand this. You shut down these 24/7, 365 US dollar networks, which were mostly being used by crypto, not entirely, but mostly. There was a real risk management reason why. And by shutting them down and making all the parties for the Bitcoin ETF carry unsettled trade exposures after hours and on weekends, what did you do? You put that default risk into the GSIBs, right into the center of the financial industry, instead of keeping it in a relatively small bank where it could be managed and ring-fenced. Congratulations, Fed. You made too big to fail bigger.
Well, and like the more general overarching thing is that, like, okay, so there's people like me who drive fast cars and drive really fast, okay? That doesn't mean that nobody can drive. You know what I mean? It's like, you still have to let people drive. You know what I mean? Because we got to get to places. You know what I mean? And the problem is the regulator said, like, John is speeding, so nobody in America gets to drive. I'm sorry, America. I didn't mean to do that.
It does sound like there's agreement that there's going to be some upheaval in banking supervision and regulations, perhaps, going forward. That's much needed. For anyone who's tuning in, thank you for being part of this 7 Investing podcast experience. 2 experts on the show today, Caitlin Long, the founder and CEO of Custodia Bank, John Maxfield, lifelong student of banking, also host of the symposiums. You can follow them at Caitlin Long. That's at CAITLINLONG_ on Twitter X, or Maxfield on Banks. That's Maxfield with 1 X on Banks. Just to have a little bit of fun here in the last couple of minutes, because I do have 2 experts. As we said earlier, we've got 2 different sides of the Venn diagram. We've been agreeing on the middle ground about regulation.
Bring it on.
I have to mix it up a little bit because for the enjoyment of my audience, who is investors, we are representing individual investors with 7 Investing. But just to have some fun, I'm going to play a game of over and under on this. I'm going to put something out there. You don't have to answer if you don't want to. Let me know if you can't answer. But just for the fun of this is not financial advice. This is nothing, this is just for fun at the end of the program here. So take that with a grain of salt. But I'm going to throw something out there. I'll ask one of you first if it's going to be higher or lower than what I'm saying, and the other person can then agree or disagree with the statement. Do you guys understand, or are you ready to begin?
I think so, yes.
Okay, the first one I'm going to start with you, Caitlin. I think I know the answer for this one, but cryptocurrency has been very much more in favor the last couple of years, and Bitcoin is honing in on $100,000 per Bitcoin. We've seen the red eyes on your Twitter page. You've been a big fan of this for a long time. Is the price of Bitcoin higher or lower than $100,000 in 3 years?
In 3 years? Oh, higher.
John, do you agree? Higher or lower than that?
Um, okay, so I'm gonna pull a Morgan Housel. Okay, I'm gonna say the same.
Okay, okay.
I'm gonna say the same.
Thumbs up on
Just because
price.
I have no idea, because if you go exactly 3 years from now, maybe you're in maybe like the market gets caught. You know what I mean? Like it's a very volatile asset, but generally it's trending up. So I think the bias is up, but I'm gonna be a Morgan Housel thing and say the same.
Two thumbs up on Bitcoin being more than $100,000. Second one, I'm going to start with you on this one, John. One of the most popular publicly traded companies in the crypto space has been Coinbase. You know, one of the largest custodians. You can buy and sell Bitcoin on that. Always kind of takes a commission from it, but it's often doing a lot of other things too. It's now up to an $80 billion market cap, largely due to the commissions on the trades that are taking place out there. Is the market cap of Coinbase greater or lower than $80 billion in 3 years?
Oh God, that's a great question. These are unfair, but I'm gonna play. You've asked me to play, so I'm going
Correct.
to.
This is for the enjoyment of the audience, John. I don't make the rules. I just play by them.
I'm gonna say under. Okay, Caitlin, I'm sure is gonna disagree with me, but here's why. There's so much liquidity in the system. These valuations are just wacky. They're just wacky right now, and not just in crypto, but just like in all sorts of stuff. They're wacky. So my belief is that at some point they're correct, but like I don't know.
Caitlin, do you agree, disagree? Is it higher or lower?
No, I'll say higher because Bitcoin is very correlated to Bitcoin's price, and Bitcoin goes through 4-year cycles, and we're in the bull part of the Bitcoin cycle. Typically, if past is prologue, and there's a fundamental reason for that. It has to do with the timing of what's called the halving of Bitcoin, which happens about 6 months before a U.S. presidential election, and by the time of the U.S. presidential election, we tend to be in a rip-roaring bull market. We're in the 4th cycle. And it's happened every time. So if past is prologue, we'll still be in a bull cycle. And in 3 years, we'll probably be in the bearish part of the cycle. But the reason I bring that up is I think that one of the biggest questions that's unanswered is the Fed has already approved Bank of New York Mellon, and I've been told will also or has already approved State Street and Goldman to get into the crypto industry. Of course, they're holding back the small banks like Custodia. And helping the big banks. But what is the impact of the big Wall Street firms coming into Coinbase's market? That's a big unanswered question. I would say likely higher, but with that caveat.
Okay, so that's a great question. Maybe it brings me to my next one on overrun. I'll start with you on this one, Caitlin, since you brought it up. But there are some funds that are now able to trade cryptocurrencies in retirement accounts. You know, $40 trillion in American retirement accounts, of course, larger than that globally. Generally, it's been kind of conservative guidance of, perhaps up to 5% of a retirement account could be dedicated to cryptocurrencies. Within 10 years, is that up to 5% going to be over or under a recommendation of 10% of retirement assets dedicated to crypto assets?
Above 10%. You're already seeing it. You're seeing Fidelity was the first of the big asset managers to dip its toes in. But now it's BlackRock, and once Larry Fink came to the table, the coattail effect was pretty big, and they're already moving above the 10% allocation limit. It is cyclical, so I will warn everybody. Again, I alluded to these 4-year cycles. It's technically 210,000 blocks at an average block size of 10 minutes a block timing interval of 10 minutes a block. It works out to be around 4 years, but so you do have to be careful how you buy it. I'm not a trader. I'm a buy and hold. I haven't traded around my Bitcoin position since 2017, and it's more than 10. It's more than 10% because I've been sitting on it a long time. But I would encourage folks to look at it seriously. Don't. Part of the reason it's taken as long as it has been is exactly all of the reticence of the regulators in the last 4 years that we were just talking about. Individuals have been asking for this from their wealth advisors for years, but the big banks are coming, no question, and it'll end up being more than 10%.
Now, John, you might have a lot of conservative, viewers in your audience listening to your answer on this one. Is it going to be more or less than 10% in 10 years?
Okay, so
I don't know about.
I heard she said she's held it since 2017. That's a good run for Bitcoin there. Yeah, perfect. Okay, I've got two more. These are fun ones. These are not quite so serious. We just have to end on a fun note. I'll start with you on this one, John. This is maybe Ethereum and Bitcoin get all the rage and all the attention out there, but there's a lot of cryptocurrencies, thousands of other cryptocurrencies and tokens out there. This one specifically has quintupled in price in 2024, perhaps due to the influence of one Elon Musk. But do you believe that the price of Dogecoin will be higher or lower than 42 cents like it is today in 3 years?
way higher. Wait, this thing is going to the moon, bro. This is investment advice.
Love it.
I'm kidding. I'm kidding.
Love it.
No, I don't think Dogecoin is going to be. My guess is some of these kind of like tertiary ones that are kind of playing around, kind of nipping on the edge. My guess is that a lot of them.
Do you agree, Caitlin? There's a lot of other ones out there. Yeah, go ahead.
I actually do agree. I would say lower, and it's because Bitcoin is so superior to the altcoins. I'm not such a what's called a maxi in this space that I want all the other coins to disappear. I don't. I think there's an incredible amount of experimentation going on, and thank goodness it's happening in among people who know what they're doing for the most part. Clearly, there have been people scammed. Again, if we can get regulated companies, there'll be a lot fewer people scammed. But I will never criticize all of the experimentation that is happening. If I were in a regulatory seat, I would spend a lot more money on the anti-fraud law enforcement than I would on regulation to try to go after the bad actors, because clearly there are a bunch, and some of them are creating these altcoins. But Bitcoin is so far superior to all the others. That's the one you hear me talk about almost exclusively.
I think that's a perfect place to wrap it up. I really appreciate Caitlin and John both for being on the podcast. This was absolutely phenomenal. Thank you both for being a part of the 7 Investing podcast today.
It was really fun. Thank you. Thanks for having us on. Really appreciate you arranging this. And I'm glad to be able to talk about this issue with the crossover audience. So share this all with your friends. And if you have questions, info@custodiabank.com.
Really appreciate everybody tuning in to this edition of the 7 Investing Podcast, where it is our mission to empower you to invest in your future. My name is Simon Erickson. I hope you have a great week and stay safe. We'll see you next time.